Is the era of the undisputed US dollar coming to an end, or is it just facing its first real digital competition? Hello, and welcome to a new episode of the Commute Commentary, where we look past the narrative to cut through regional bias. Today, we are diving into the evolving landscape of global currencies and the new payment systems emerging from the BRICS nations.
Yeah, and it really is this massive structural shift that's happening just beneath the surface of the global economy right now.
All right.
I mean, today we're going to look at how national wealth is moving across the board and you'll really dissect the mechanics of these entirely new alternative payment infrastructures.
Which is super complex.
Yeah, absolutely. And we'll try to untangle the competing geopolitical agendas driving all this transition, because there's a lot going on.
There really is. And, to really grasp what is happening right now, we have to start by understanding the baseline. For most of our lifetimes, the US dollar hasn't just been a currency. It's been like the operating system of global trade.
Yeah, that's a good way to put it.
Like, if you are a nation buying oil or exporting electronics or just, holding an emergency savings account for your country, which we call foreign exchange reserves, you do it in dollars.
Right, you do. And that dominance has really far-reaching effects for the average listener. Because the rest of the world constantly needs dollars to conduct international trade, there is this built-in global demand for U.S. currency.
Which is huge for the U.S. economy.
Exactly. That demand allows the U.S. to borrow money more cheaply. And that traditionally translates to lower interest rates on everyday things, like your mortgage, your car loan, and even just the cost of imported goods on the shelf.
So when that system starts to crack, it's not just some abstract banking issue. I mean, it eventually hits your wallet.
Yeah, definitely.
And the data shows a pretty significant recalibration is underway. If you go back to 1999, the US dollar made up about 71% of all global foreign exchange reserves.
Right.
But today, that share has fallen to 57.74%.
Which is, a drop of over 13 percentage points for the world's reserve currency is monumental.
Yes.
It really is. It reflects a deliberate choice by central banks globally to diversify their national wealth, away from a single point of dependency.
But they have to put that wealth somewhere, right? If countries are holding fewer dollars, what are they buying instead?
Right. That's a big question.
I was looking at the recent figures on commodity hoarding, and we just crossed a historical milestone. Official gold holdings worldwide now stand at $3.909 trillion.
Yeah, and the significance of that number really becomes clear when you look at what it sits next to on the global balance sheet. That $3.909 trillion in gold is now practically at parity with the $3.920 trillion held in U.S. Treasury securities by foreign governments.
Wait, really? So they are basically tied?
Basically tied, yeah.
So for the first time in modern monetary history, physical metal and U.S. government debt are carrying equal weight in the portfolios of global central banks. That is wild.
It is.
But looking at the breakdown, this gold rush isn't evenly distributed, is it? It's heavily skewed.
Oh, very heavily. A few specific emerging economies are driving the vast majority of this accumulation.
Like who?
Well, Russia, for one, is holding nearly 1,894 tons of physical gold.
Wow.
China is right behind them with over 1,807 tons. And then you also have Turkey holding roughly 705 tons, and India with over 523 tons.
Okay, so when you see those specific nations aggressively loading up on physical metal like that, it forces a question, right? Are central banks treating gold like a financial doomsday bunker, or is this just standard portfolio diversification?
Well, it really depends on the economic posture of the country in question. For a lot of central banks, gold is just a classic hedge.
Right.
It has historical stability, and most importantly, a physical bar of gold carries zero default risk.
Because it doesn't rely on another government's promise to pay.
Exactly. But for the primary drivers of this trend, that specific group of nations accumulating the bulk of these reserves, it is undoubtedly a strategic geopolitical maneuver.
Let's explore the motivation behind that maneuver then. Why the sudden need for a financial bunker? Right, because the underlying catalyst seems to be the very nature of the dollar's dominance, and specifically, the power to leverage that dominance through financial sanctions.
Yeah, that's the core of it. When almost all international transactions are routed through U.S.-led financial messaging systems like SWIFT, and then cleared through American correspondent banks, the United States possesses a really unique lever of power.
Yeah.
They have the ability to essentially disconnect a nation from the global economy just by restricting their access to the dollar network.
Which is, I mean, it's the ultimate financial kill switch.
It really is.
And the situation with Iran provides a stark, real-world example of how devastating that switch can be.
Definitely. The maximum pressure campaign enacted against Iran was explicitly engineered to create a severe dollar shortage within their domestic economy.
Right.
By isolating their banks from the international clearing system, the flow of trade was just completely choked off.
I try to imagine what that looks like on the ground for an average citizen. Like, your access to the global market just vanishes overnight. And the mechanics of that isolation cause the Iranian rial to utterly collapse. Reports indicate that by December 2025, the exchange rate plummeted to 1.4 million rials for a single U.S. dollar.
Yeah, 1.4 million. The macroeconomic fallout was staggering. I mean, it even included the failure of a major Iranian financial institution.
Wow.
But if you zoom out from Iran for a second, for other non-aligned nations watching from the sidelines, that economic collapse served as a blaring siren.
Because it demonstrated that relying on the dollar means your economy exists at the discretion of U.S. foreign policy.
Exactly. And from the perspective of countries like Russia and Iran, the United States is actively weaponizing the global financial system to punish its adversaries.
That is their specific perspective. We do not endorse or validate that stance, but it shows how polarized the conversation has become.
It certainly illuminates why these massive shifts in global reserves are happening, though.
Yeah, it does. But I still struggle with the practical reality of actually replacing the dollar. Like, the idea of a shared Euro-style single currency for the BRICS nations seems completely off the table.
Oh, yeah. Reports indicate that it's definitely not happening.
Right, because their economies are far too diverse, they have different inflation rates, totally different export models. So if they aren't minting a new physical currency, what is their actual practical plan?
Well, the strategy has pivoted from trying to create a new currency to building entirely new infrastructure.
Okay.
Since a single BRICS currency proved unworkable, these nations are focusing on the plumbing of global finance. They're constructing alternative payment rails that just bypass the dollar network altogether.
Okay, wait. So instead of trying to invent a completely new type of car, a single BRICS currency, they're just building a parallel highway system next to the old toll road.
That is a highly accurate way to visualize it, yeah.
Yeah.
And they're actually constructing several different routes simultaneously.
Right.
One of the primary consumer-level systems rolling out is BRICS Pay.
Let's clarify what BRICS Pay actually is, because there's a lot of confusion around it out there.
Yeah, there is.
It is described as a decentralized gateway system, right? So it's not a unified blockchain and it's not a central bank.
No, not at all. The decentralized architecture is actually the entire point.
Yeah.
By avoiding a centralized hub, each participating nation maintains absolute sovereignty over its own domestic payment system.
Ah, I see.
Yeah, so no single country or external power can just hit a switch and turn the network off.
Right.
Furthermore, it's not designed to destroy existing legacy systems like SWIFT or Visa.
Right.
It just operates alongside them as a parallel option.
Okay, so walk me through how this functions in the real world. Say you are a tourist from Brazil visiting another member nation.
Sure, so the user experience is built to be completely frictionless.
Yeah.
Starting in the first quarter of 2026, the retail phase, which is the consumer-to-business layer, is launching.
Okay.
A tourist will load an electronic wallet on their phone and purchase goods simply by scanning a QR code at a local shop.
Oh, wow.
Yeah, they won't need to open a local bank account or visit a currency exchange to trade physical cash at all.
That covers the everyday consumer. And I know the corporate side, the heavy business-to-business cross-border payments, is scheduled to follow later in 2026.
Right. But, BRICS Pay is really just the surface level.
Yeah.
The real foundational shift, the heavy lifting between the central banks themselves, is taking place on a different digital highway. And that project is known as mBridge.
mBridge. Okay, this is a massive piece of the puzzle. It is a wholesale central bank digital currency platform.
Yes.
And the participating roster is striking: China, Hong Kong, Thailand, the UAE, and Saudi Arabia. But let's pause and define what a wholesale digital currency platform actually means for the listener.
Good idea. So a retail digital currency is what everyday people would use to buy groceries, like we just talked about.
Right.
A wholesale digital currency is strictly for financial institutions. So mBridge allows central banks and large commercial banks in these different countries to trade directly with one another in real time.
Using digital versions of their own currencies.
Exactly. Using digital versions of their national currencies completely outside the traditional US-led banking infrastructure.
And the adoption rate of this platform has been incredible. Back during its pilot phase in 2022, Enbridge processed a modest $22 million in transactions. But fast forward to late 2025, and transaction volumes had surged to $55.49 billion.
Which is just a massive jump. The scale-up proves the technology is viable. However, the geopolitics surrounding it are, well, they're tense.
Very.
In October 2024, the international coordinating body that was originally backing and incubating Enbridge abruptly stepped back from the project.
Yeah, and officially they stated that the Enbridge platform had simply graduated and no longer required their oversight.
Right, that was the public reasoning.
Right.
But geopolitical experts who monitor financial diplomacy widely suspect the withdrawal was prompted by intense Western pressure.
Because of sanctions.
Exactly. There are deep concerns in Washington and Europe that a fully operational Enbridge could be utilized as a primary tool for evading international financial sanctions.
Because it operates entirely in the digital realm, completely outside the purview of traditional correspondent banks.
Yes, exactly.
And alongside Enbridge, there's another proposal gaining traction called the unit.
Oh, the unit is a fascinating concept. It's designed for future trade settlement. It essentially operates as a synthetic accounting unit, specifically for pricing and invoicing cross-border transactions.
Wait, I want to make sure I understand this. What exactly is a synthetic accounting unit?
Think of it like a universal yardstick rather than a physical coin you put in a vending machine.
Okay.
When two nations trade, say, exporting timber or importing steel, they need a stable benchmark to agree on the price. Traditionally, they use the US dollar as that yardstick.
Right, of course.
The unit is proposed as an alternative benchmark to measure the value of the trade without actually requiring dollars to settle the bill.
And the way this yardstick is constructed is what makes it so unique. The proposal suggests a 40-60 split, right?
Yes.
It would be backed 40% by physical gold, specifically 0.4 grams of gold per unit, and 60% by a basket of local currencies from the BRICS member nations.
Exactly. By anchoring 40% of its value to gold, they introduce a neutral, universally recognized asset to provide stability.
That makes sense.
Yeah. So you price your international trade in units to avoid currency fluctuations, but the actual payment can still be fulfilled using the local currencies of the countries involved.
Oh.
It is just yet another architectural layer designed to remove the dollar from the equation.
So the highways are definitely being built. But if Enbridge is the road, what vehicle is actually doing the driving?
That's the billion-dollar question.
Looking at the central bank data, it is overwhelmingly China's digital yuan.
The ECNY, yeah. Based on recent analysis, the digital yuan accounts for over 95% of the total settlement volume occurring on the Enbridge platform.
Over 95%.
Yeah.
That means this alternative global infrastructure is essentially running on Chinese digital currency.
Pretty much.
And internally, China's domestic growth with the ECNY is just as aggressive. It has expanded by 800% since 2023, processing over $2.3 trillion by late 2025.
It really stands as the most extensive, live, central bank, digital currency deployment in the world. But, the true breakthrough with the ECNY isn't merely the transaction volume.
No.
No, it is a fundamental structural pivot that happened on January 1st, 2026.
This is a crucial detail. On that date, China quietly reclassified the ECNY. They shifted it from being categorized as digital cash to being legally classified as an interest-bearing digital deposit.
Right. And to appreciate the gravity of that change, we need to discuss the core fear that has largely paralyzed Western central banks from launching their own digital currencies.
Okay.
It's a concept called disintermediation.
Let's break that down for the listener. How does disintermediation threaten the traditional banking system?
Well, consider how a commercial bank functions. They rely on your everyday deposits to fund the loans they issue, mortgages, business loans, auto loans. If a central bank issues a digital currency that is as safe as physical cash, but as easy to use as an app on your phone, the fear is that citizens will pull their money out of traditional commercial banks and just store it directly with the government.
Which makes sense. Like, if the government is offering a perfectly safe digital wallet, why risk keeping your money in a private bank?
Exactly the problem. If commercial banks lose their deposit base, their ability to lend money evaporates.
Wow.
And that could severely destabilize the entire credit system that modern economies run on.
Wait. So while Western central banks have been tiptoeing around CBDCs because they're afraid of disrupting commercial banks, China just reclassified their digital currency to solve that exact problem.
Yes. By reclassifying as a digital deposit, China allowed the ECNY to sit directly on the balance sheets of commercial banks.
Oh, that's clever.
It is. It's covered by standard deposit insurance, and crucially, it earns interest at normal deposit rates.
So imagine you open your regular banking app, but the money sitting there is a direct digital claim on the central bank, and it actively pays you interest.
Exactly. The Chinese central bank avoided displacing the commercial sector. Instead, the ECNY became the standardized technological foundation beneath it.
Right.
And by allowing it to bear interest, China is aggressively positioning their state currency to compete head-to-head with massive private domestic platforms like WeChat Pay, as well as international dollar-backed stablecoins.
It is just a profound monetary experiment unfolding in real time. But, as seamless as China's digital expansion appears, the broader BRICS coalition is definitely not a monolith.
No, not at all.
Not every member is eager to trade a U.S.-dominated system for a China-dominated one.
Right, and India provides the most prominent example of this internal friction. Their strategic posture reveals a really deep reluctance to be cornered by China's growing influence over these shared financial platforms.
Because India is actively playing a multi-vector geopolitical game. They want the benefits of alternative trade, but they are fiercely protective of their strategic autonomy. A major flashpoint occurred recently. Russia had accumulated an excess supply of Indian rupees from oil trades, and they demanded that India begin paying for future oil shipments in Chinese yuan.
And India rejected that demand outright. They maintained that trades must be settled in either US dollars or Indian rupees.
Right.
They just have zero intention of accelerating the internationalization of the Chinese currency at the expense of their own.
And India's maneuvering didn't stop there. Reports indicate that in February 2026, India essentially broke ranks with the broader BRICS strategy by finalizing a significant direct trade agreement with the United States.
Yeah, it was a very calculated geopolitical pivot. Under the framework of that February deal, India agreed to halt its procurement of Russian oil.
Wow.
And in exchange, the United States agreed to substantially lower tariffs on a wide variety of Indian exports, bringing them down to an 18% threshold.
So India leveraged its position perfectly between two competing global powers to secure economic advantages.
They did.
And this really highlights the U.S. perspective. The United States is clearly not passively watching these alternative systems take root.
No, definitely not. The defense of the dollar's supremacy remains a paramount priority for U.S. economic and national security strategy. And we see this manifested in both aggressive policy rhetoric and technological countermeasures.
On the policy front, President Trump has explicitly threatened to weaponize trade, stating he would impose 100% tariffs on any BRICS nation that attempts to dethrone the U.S. dollar as the world's primary reserve currency.
Right, so that is the punitive approach. But Western financial institutions realize that threats alone cannot stop technological evolution.
Right.
They're also developing their own next-generation financial infrastructure. And the primary initiative to watch here is called Project Agora.
Project Agora. It serves as the Western answer to platforms like Enbridge, right?
Yeah.
It is a massive collaborative effort involving 7 major central banks, including the U.S. Federal Reserve, the Bank of England, the Bank of Japan, and the European Central Bank, working alongside private sector financial firms.
Yeah, and the goal of Agora is to modernize the legacy correspondent banking system. They are testing what is called a unified ledger system that utilizes tokenized deposits.
Let's translate tokenized deposits for the listener. What does that actually look like in practice?
So imagine taking a traditional bank deposit, which is historically just an entry on a rigid, isolated database, and converting it into a programmable digital token.
Okay.
Sort of like a highly secure, smart casino chip. This token carries all the necessary compliance and verification data right within itself.
Oh, I see. So instead of payment taking 3 days to clear because multiple banks have to manually verify the transaction across different time zones, these smart tokens can instantly interact on a shared digital ledger.
That is the objective. Agora aims to facilitate instantaneous 24-hour cross-border payments involving multiple currencies. It is a concerted effort to make the established Western-led financial infrastructure just as fast and frictionless as the new digital alternatives emerging from the BRICS nations, but, without sacrificing the regulatory oversight of the traditional banking system.
It is truly remarkable to watch all of this unfold. We are witnessing a literal bifurcation of the global financial architecture.
We really are.
On one side, you have the modernization of legacy systems with initiatives like Project Agora. On the other side, you have entirely parallel infrastructures taking flight, like BRICS Pay, Enbridge, and China's digital yuan.
It's the messy, complex birth of a multipolar financial world. Nations are just no longer content to rely on a single global standard.
Right.
They're actively hedging their bets, integrating into multiple competing payment systems to ensure they have options. If any one network is compromised by either technological failure or geopolitical conflict.
It is a dizzying landscape where the flow of digital money is rewriting the rules of international power. How this multipolar system ultimately settles will dictate the future of global trade. And that wraps up our discussion for today. Browse our show for more global insights and subscribe so you don't miss the next shift. See you next time on the Commute Commentary.